What's up, traders? In today's video, I'm going to go over a few questions that have been asked in the chat room of late. This video is going to be aimed more at the newer trader, so if you're already a professional trader and already making money in the financial markets, this video is probably not going to be for you. However, if you are new at this and you're just getting your feet wet, it's not going to be an exact basic tutorial as far as how everything works, but it is going to be an enlightenment experience, or an enlightening experience, I should say. So sit back, relax, and let's dive in. What's up, everybody? My name is Heath, and this is Trade Talk. So in the chat room, I've been getting asked a lot of questions for me to kind of go over some basic info as to what I look for in these markets when I'm taking my scalp trades. Our swing trading method is very well documented through Jordan Lindsay's Conquering the Markets trading group. There's links in the description below if you guys are interested. However, as far as my scalping methods, those are not taught, and I've been with Conquer ever since it started. So, and I've been a moderator pretty much the whole time, answering questions for newer traders. So I'm going to go over a lot of that stuff today. I'm going to discuss what I look for, why I look for it, and how we can turn that into possible profitability. So let's get started. We're going to start with the Euro USD, because if you've been watching the videos that I've been putting out on a regular basis lately, you will know that we were watching this high, because once the dollar was starting to sell off, the euro is heavily weighted in the DXY basket, so they trade almost inversely, not 100% inversely, but very heavily inversed. So basically, if you have a lot of weakness in the dollar, you're going to have strength in the euro. We were looking for this high to get breached, because it's the last high that was put in this range from this last climb. So we're at like yearly highs at the moment. So now we did have this corrective move here, and this corrective move spanned from July the 27th until it broke out yesterday. So that's a few months in this range here. So basically, we're getting ready to come up into some more range bound activity that happened way back here in 2018, and that will offer up some kind of resistance, I'm sure. I just don't see price blasting through all of this, you know what I mean? So there's going to be pullbacks, and we just don't know what's going to happen. Now, on the very, very basics of basics, basically I look at candlesticks. Candlesticks is our best indicator as a trader, and you will hear me say that a million more times, because it is absolutely true. Support and resistance levels are great, trend lines are good, but as far as actually what is price doing, the candlesticks tells you that. Now, we do have shakeout moves a lot of times. Those shakeout moves are hard to trade. And also range-bound moves. Range-bound moves are hard to trade as well. But whenever the markets are trending, it's a nice, awesome experience, because you just feel like you know exactly what you're doing and everything's working out. It's just, in a trend, anybody can make money. So I don't even really know where to start. Okay, let's start with the Euro USD, because this green line right here delineates my open position, which you can see right there with this little blue circle, means that I am long this pair. This is a live account, as you can see down here. So what I was looking for when I took this trade, I was looking for price to break above this line, because the week before last, I was actually looking for price to break above this high. Once it did that, then I decided, or realized, that, price is moving up. It's showing a tendency to move higher. How do I gauge trend? Okay. Basically, on a daily chart, you can see market structure highs. For instance, this high right here. this would be considered a market structure high. Price moved up, created a high, traded sideways, and then moved down. Now, in this range, give me 1 second. In this range, this low right here would be a shorter term market structure low. Okay? This was a market structure high from a trend move. So basically, whenever you have a price swing, that price swing, the low and the high of the swings become market structure. So once we broke this market structure high with this move, we traded down. We did trade below this area here, and that was a market structure, but not a heavy market structure. This is like an intraday or intra-week type of market structure. I look for main market structures to be broken. This is a main market structure low. Over here, we didn't take out this market structure low. When we traded back down into here, this was the new market structure low. These two candles bodies right here. This is the close of this day and the open of this day. So when we pushed back down into there, we didn't even purge on the first attempt to go below. We rejected and we moved out of there. This strong bullish candle here was, it was a strong bullish candle. These Forex markets love to fake people out, guys. It's just the way it is. But these strategies can help. We took out this low. We purged the liquidity here, but we never closed a daily candle below it. So since this day here, my bias on this pair has been to the upside. So we took out this market structure on a daily candle closing basis. Now, when is this uptrend voided? When the low of this uptrend is taken out on a daily closing basis. So as of now, as of this time, since we closed a daily candle above these clear and obvious closures and opens, that to me told me that look for a pullback to get long. Now, once we took out this market structure, this being the market structure is the lows and highs are very important as well, but market structure is always going to be the body of the candle. The body of the candle is going to offer up much more resistance or support, determining in which direction you're trading, than a wick. Okay? So if you look at these two candles here, this was the close, this was the open. We traded above. So while we were going up, this candle was green, and then we rejected and then made a daily bearish engulfing candle. Okay? But the line still would be there. For instance, just like this. What happened? Just like this. So I would place my line here. When we traded back up into here, we traded above it, closed below it. Same thing here. But these 2 days here, we closed up against the line and then rejected. But then this happened. This daily close was the first daily close above this line since this market structure high was put in. Okay? That told me that I'm looking for pullbacks to get long. Okay? So that's how I gauge direction. I look for market structures to be taking out on a daily closing basis. And not every candle is a market structure. Refer back to earlier, a market structure is a turning point in the market. So this would be a market structure low. Time is fluent. It keeps making new waves throughout the process. As the market moves forward in time, it will move in waves and create new market structures highs and new market structures lows. For instance, on this push up, this huge push up that we've seen in the last few days, this area here is going to be the market structure low of this current bullish push. So if we trade back down and close a daily candle below this price swing on this bullish move up, then I will probably be looking for price to resolve itself in a clearer aspect. So I definitely wouldn't be looking for more bullish trades if we close below this market structure low since this push up, if that makes sense. When I took this trade on Euro USD the other day, basically, we made a new high, okay, and then we rejected hard out of that area. But even on a 15-minute basis, you can see we didn't even close any 15-minute candles below this market structure low. So I was looking for this to continue higher, and it did. We put in a new high and then rejected. But since we never took out this low, I was still looking for bullish entries. So the next day, this was at the close of the day right here. This was the close of the day. So that's a strong bearish candle and a strong bearish close. We traded up, and this is the Asian session right here. And then we bounced out of there. Now the Asia session is very, very, usually how can I say this? The Asia session does put in a lot of false signals. So I usually wait till New York to trade. So when we popped out of the Asian range, the next morning, I was looking to get long this. Now I wasn't just going to long when we came back into the Asian range. I wanted to see the market show me a willingness to trade away from the Asian session. Basically what I mean by that is if the candles came down, retested, bounced, showed a wick, and then closed another 15-minute candle lower than these two candles right here. Why? Because that's your market structure on a 15-minute time frame chart until these two candles get taken out by another 15-minute closure. Your market structure is bullish, and this is your market, or your market profile is bullish, and this is your market structure low. So I don't just buy. I want price to show me a willingness to trade back away from the market structure, and it did right there. As you can see, we traded down into here and then bounced. Once we bounced, I knew this was resistance before breakout, retest the support to see if it holds a support, and it did. When this candle popped up, I bought on this candle here with a stop below here. I wait for market structures to be broken, and in choppy markets, market structures will be broken left and right, up and down. It's our job as traders to not trade choppy markets. How do you do that? It's simple. You take a trade expecting a high or a low to be taken out. If you get stopped out and the market's choppy the rest of the day, you don't trade again. You eat one stop, wait to see what happens. So we traded higher, and we ultimately took out this target. And I showed you yesterday, this was my target. So I am still in this trade, and it's working out great. I mean, this thing it's on a tear, and it's to be expected because when you break out of a range, a long range, on a daily closing basis, that usually, not all the time, but usually leads to continuation. I had a question about risk on, risk off. Now, risk on, risk off, in my opinion, it's not really something you need to worry about because it's very difficult for newer traders to wrap their head around risk on and risk off. When risk is on, that essentially means that financial planners and trading firms, prop firms, any kind of multi-billion-dollar trading firm that handles billions of dollars, they leave risky or less risky assets, and they put their money in more risky assets. For instance, back in March, everything sold off at first because it was a liquidation shock. In a liquidation shock to the market, no asset is safe. However, once everything started to kind of pan out a little bit, you could see gold had a strong move up. Gold is a safe haven asset. So it is a risk off asset. When there's risk off in the market, gold tends to go higher. Another risk off asset is silver, the Swiss franc, the Japanese yen. These are all risk off assets. So basically, whenever the market is scared or there's uncertainty, people will take their money out of risky assets such as the S&P 500, such as Bitcoin, such as regular stocks, and they'll buy risk off assets like gold and Japanese yen and US dollar. The US dollar is a risk off asset as well. As you can see, by the markets are all going up. We are in a risk on environment. Gold is going down, Bitcoin is going up. All of the riskier currencies are going up. Euro, Aussie, New Zealand, pound, all of them are going up. The S&P 500 is going up. Tesla's breaking all-time high every day. It's like the market is extremely bullish all around the board. People are no longer fearful. They are in account growth stage. So risk on, risk off just essentially means that firms are reallocating funds to safer assets and risk off, and therefore when risk is back on, they reallocate those funds, or also known as capital rotation, back into riskier assets. It doesn't happen every single day. Like when I hear the CNBC news company say, oh, it looks like it's a risk off day. No, let me explain something. Risk on and risk off doesn't happen over a day. It happens over weeks. It takes a long time for firms to reallocate trillions and billions of dollars into different assets. That's why you get such whipsawed, aggressive movements up and down, and you really have no trend until basically all the financial advisors have gotten the positions they want to hold for roughly a month or two. Then you will get a nice trend that'll last for that little bit of time. Once there's more certainty in the market, things start to look up, then they slowly start to reallocate those assets back into riskier assets. So don't hang too much on the risk on, risk off words. Just don't even worry about them. The chart tells you what's happening. Right now we are risk on. As you can see that by gold. You can see that by Bitcoin. I mean, you can simply see it. This isn't market makers holding the price of gold down because they got a vendetta with gold. No. Money managers, financial planners, prop firms, every kind of money management firm that uses the markets to either manage other people's money or their own, they are what moves the market by rotating capital from one asset to another. Right now, the market's risk on. How would we know when the market's risk off? Well, the S&P 500 could start taking out lower market structures. That could be a very good indication. So as of right now in the market, this is your shorter term market structure, low. This is your longer term market structure, low. Actually, I like this one better. We start closing daily candles below here, then chances are something's up and it's time to start being a little bit more careful. So in closing, you basically wait for daily candles to take out market structures. This would be the market structure on this pair. I am watching this pair, by the way. I am watching this pair closely because as far as I'm concerned right now, we are still bullish because we have not closed a candle below these two lows. Now, if this candle comes down and closes, I want at least a full session closure below this level. If I wake up in the morning and we have a closed 8-hour candle back below this low, then I will look for lower prices. Or back below this line, I'm sorry. However, if we do not close an 8-hour candle below this line, I will be looking for scalp trades tomorrow morning in the New York session, and I will be targeting this high if it hasn't been taken out yet. If we're still trading in a range down here, when I wake up in the morning, I will be taking a long, looking for liquidity to be purged above this high. So I hope this video helps you guys. I'm sorry if I rambled on a bit and got off topic. It's kind of hard to do this. So what I think I'm going to do is I think I'm going to try to put together a live stream. So that way I can just answer your guys' questions live. I don't know if my internet is strong enough to do that yet, because I have really slow, terrible internet where I live. And there's a reason why I can't get any better internet at the spot that I live. It's just, there's a bunch of reasons why, and it's terrible, because I would be willing to pay $1,000 a month for it if I could get it. I can't get it. This is the best I get. So I'm going to try to put together a live stream. Maybe we'll do that this weekend. And this way I can answer your guys' questions straight off the rip. It's a whole lot easier to go over stuff and teach people when you can answer their questions live. And with I have a very small following right now. So with this small following, it would be pretty simple for me to try to stay engaged with you guys. So please like the video, subscribe, and all that jazz. And I'll see you next time.